students to the massive open online course on money and financial markets. In today's module, we are going to learn about the concept and the structure of the Indian capital markets. The basic objective of this course would be to really understand what capital markets are all about, what is the structure of the Indian capital market, who are the participants in the Indian capital market, what are the instruments that are in use in the Indian capital market, and also we will try to learn in depth about the government securities market. Now, what are capital markets? Capital markets are venues where savings and investments are channeled between the suppliers who have capital and those who are in need of capital. The entities that have capital include the retail and the institutional investors, while those who seek capital are the businesses, the government, and of course, the households or the general public. Capital markets also seeks to improve the transactional efficiencies. These markets bring those who hold capital and those who seek capital together, and hence provide a place where entities can exchange securities amongst themselves. We need to understand what are the examples of capital markets. Now, for example, we all know about the stock market. A stock market, or if you call it an equity market or share market, is basically an aggregation of buyers and sellers of stocks, which represent ownership claims on businesses. On the other hand, we do have the bond market, which also is an integral part of the capital market. The bond market is a financial market where participants can issue new debt known as the primary market or buy and sell the debt securities. And thirdly, we have the currency and the foreign exchange market. The foreign exchange market is a global, decentralized or over-the-counter market for the trading of currencies. This market determines the foreign exchange rates for every currency in the world. If we look at the capital market, we can see that basically there are two entities. One who supplies capital and the other entity is the person who needs capital. Usually, entities who have surplus capital in the capital markets are basically the retailers and the institutional investors. And the entities who are seeking capital are mainly the people, the governments, and of course, the businesses. Now, if we try to find out who are the suppliers of capital in an economy, we find that, suppose for example, the pension fund. A pension fund, which we also know as the superannuation fund in some countries, is any plan, fund or scheme which basically provides retirement income to the entities. We have the life insurance companies which offers contracts between an insurance policy holder and an insurer or assurer, where the insurer promises to pay a designated beneficiary a sum of money or benefit in exchange for a premium upon the death of an insured person who is often the policy holder. The Insurance Development and Regulatory Authority of India manages everything related to insurance in India. We also have the non-financial companies. They are businesses which do not accept deposits or which are not in the business of giving or making loans. Like the non-financial companies mainly are the healthcare, technology, the industrial sectors, all those companies which are related to these type of sectors. We also have charitable foundations. which are a category of non-profit organizations that will typically provide funding and support for other charitable organizations through various types of grants. So these are certain examples of suppliers of capital, entities who have surplus capital and would like to supply this capital to the market. And then we have some examples of users of capital, like people who looks to purchase vehicles, homes, etc. Or we have the government who is in need of money or capital, and also we have the non-financial companies. Let us look slightly backward to find out what do we have in store in the context of the Indian capital market and its history. Now, the Indian capital markets have a history of more than a century, and it was relatively inactive till the 1970s. We all know that during the Rajiv Gandhi regime, that is during the 80s, we had the Indian economy partially opening up. So we call it the partial liberalization of the economy, and we also had pro-capital market policies during the 1980s. And this helped to infuse some life into the markets, but still we can say that it was only during the economic liberalization that was ushered in after the 1990s that did provide a lasting impetus for the Indian capital markets. So today, the segments of Indian capital markets we can say are comparable with counterparts in many of the advanced economies in terms of efficiency. Efficiency, I mean in terms of price discovery, tradability like the low impact cost factors, resilience in terms of co-movement of rates across product classes and yield curves, and also in the context of stability. In particular, we can say that the Indian capital market and their ability to withstand several periods of stress. Notably, we had the Asian financial crisis in 1997-98. We had the global financial crisis in 2007-2008, and we also had the taper tantrum episode in 2013, all of which the Indian capital market successfully withstood, and we can say that it is surely a sign of increasing maturity for the Indian capital market. So, if we now go into the whole structure of the Indian capital market, we can say that the capital market structure has evolved over time with the market practices and conditions generally reflecting the policies that are put in place. Till the onset of reforms in the 90s, raising of resources in the primary segment of the market was subject to several controls, disallowing the prices to be determined by market conditions. Trading also in the secondary market was subject to not very much transparent practices. The practices was very much opaque in character. The trading and settlement system was outdated and out of tune with those internationally followed practices. However, we did find that volumes increased and securities continued to exist in the physical form. Physical securities, it also creates uncertainties for investors, and it also increases the transaction cost. And because of these long and uncertain settlement cycles, it really created serious problems for the clearing houses. And informational flows to the market participants were also deficient in nature. And as the process of price formation has to be efficient for the growth and stability of the market, it was considered necessary to orient the Securities and the Exchange Board of India, that is a SEBI, to undertake the task of regulation and supervision. And the SEBI was for this purpose given statutory power through a separate legislation in 1992. Now, coming directly to the structure of the Indian capital markets, we can say that the Indian capital market can be directly characterized into two broad segments. We had the primary market and we have the secondary market. Now let us look at it one by one. Now what is a primary market? Primary market are the new securities that are originally launched in the stock market are primarily the focus of the primary market. So as a result, the primary market, we do have another name for it. It is also called the fresh issue market, because here we are dealing only with the newly issues stocks. The primary market's fundamental purpose is to make it easier for the businesses to transfer the freshly issued shares to the general public. Now, the financial institutions, the banks, the high net worth individuals and others, these entities are the key investors in this stock of or in this type of market. Next, we come to the concept of the secondary market. What is a secondary market? It is also called the auction market and the dealer market. These are the broad two distinct subcategories of the secondary market. The open outcry mechanism, where buyers and sellers gather in one place and call out the prices at which they are ready to purchase and sell their assets, and it's specific to the auction market. Example of such markets in India are, say, the National Stock Exchange, the Bombay Stock Exchange, and so on. However, when we look at the dealer markets, commerce occurs across electronic networks and the majority of small investors transact on dealer marketplaces. We should now look carefully at what are the functions of the secondary market. Now, secondary market is vital to an efficient and modern capital market. So if we want to really have a booming capital market, obviously a very much efficient modern capital market is utterly necessary. Because in the secondary market, we know that securities are sold by and transferred from one investor or speculator to another. So it is therefore important that the secondary market should be highly liquid. As a general rule, the greater the number of investors in the secondary market who participate in a given marketplace, and the greater the centralization of that marketplace, we can say that that market obviously would be more liquid in nature. So we can say fundamentally that the secondary markets mesh the investor's preference for liquidity with the capital user's preference to be able to use the capital for an extended period of time. So we saw that in the secondary market, stock exchanges play a very important role. Stock exchanges are open markets that trade financial assets. Whether associated with a company or acting as an individual, a stock exchange is the place where stocks are bought and sold. There are a number of major stock exchanges around the world, and each of these plays a part in determining the overall financial and economic condition of any economy. And stock exchanges deal with a number of financial instruments such as bonds, equities, and stocks. Both corporate and government bonds are traded in stock exchanges. Now let us look at the instruments of the capital market. The instruments mainly are the equities. Equities are the net difference between a company's total assets and its total liability is known as a company's equity or a shareholder's equity. When a corporation has publicly traded stock, its market capitalization may be determined by multiplying the share price by the number of the outstanding shares. We have the debt securities. Financial instruments known as debt securities gives the owners the right to receive regular interest payments. Debt securities, in contrast to equity securities, call on the borrower to pay back the principal amount that has been borrowed. The perceived creditworthiness of the borrower will have an impact on the interest rate for a debt security. And thirdly, we have hybrid securities, which are a single financial security which combines two or distinct financial instruments, and they're often referred to as hybrids because they typically incorporate both the loan and the equity features. In the broad spectrum of the structure of the Indian capital market, SEBI, the regulator, plays a very important role. SEBI is the Securities and Exchange Board of India. It is a government agency, and among all the other responsibilities that it has, it regulates the capital markets to protect the investors from any sort of fraudulent practices or frauds. Regulation basically refers to the actions taken by the government-instituted regulatory bodies to monitor, manage, and oversee capital market processes. And SEBI is the only body that acts as the sole regulator in the Indian capital market. Now, let us go back to the primary security or the primary market. Now, how are securities issued in the primary market? Now, mainly it is done through public issue through prospectus, and public subscribes directly. Section 67 of the CAA 2000 provides that where the offer or invitation to subscribe for shares or debentures is made to 50 or more persons, then such an offer or invitation shall be deemed to be a public offering and shall have to comply with all the provisions of the Act as well as the SEBI guidelines applicable to such public offerings. These type of public issues are generally open to the public, to the general public. Wide publicity about the offer is generally given through the media. In the past, prominent brokers were entrusted with such a task. But nowadays, we find that merchant bankers play this role that was previously played by prominent bankers. Then there is another method which is called offer for sale. In this, the new securities are offered to the general public by an intermediary, that is by a firm or brokers who buys a full lot of securities from the company itself. So how does it occur or how does it work? Firstly, the company issues the securities to the intermediary at a face value. Then the intermediary will then issue the security to the general public at a higher price and then earn profit on it. Another method is private placement. Now the securities are sold by the company to an intermediary at a fixed price, and then the intermediaries sell these securities not to the general public but to selected clients at a generally higher price. And in this context, no prospectus is issued in private placement. So private placement generally covers equity shares, preference shares, and debentures. It offers access to capital more quickly than the public issue and is quite inexpensive, okay, on account of the absence of various other expenses that are generally related with issue whenever we go for issues, general issues. Next, there is a concept called right issues. This is another method for existing companies. It is the issue of new shares in which the existing shareholders are given preemptive rights to subscribe to the new issue on a pro rata basis. The right is generally given in the form of an offer to the existing shareholders to subscribe to a proportion proportionate number of fresh extra shares at a price. Companies issue right shares by sending a letter of offer to the shareholders whose names are recorded in the books on a particular date. A shareholder has four options in the case of rights. One, to exercise his rights, that is, he might buy the new shares at the offered price. He might renounce his rights and sell them in the open market. He can renounce part of his rights and exercise the remainder. And lastly, he can choose to do nothing. And then there is another method that is called EIPOs, or the Electronic Initial Public Offer. It is a new method of issuing securities in the online system of the stock exchange. The company appoints registered brokers for accepting applications and placing orders electronically. We also have the concept of bonus issues, which is also one of the ways to raise capital, but it should be remembered that it does not bring any fresh capital. The participants in the primary market are the issuers of securities, the investors in the securities, the intermediaries. This last, that is the intermediaries, render services to both the issuers and the investors to enable the sale and the purchase of the securities. Now, in terms of size, all the major segments of the capital market, namely the central government securities market, the market for state development loans, the corporate bond market, the equity market, they all have experienced consistent growth during the past few decades in terms of primary issuance, in terms of market capitalization for the primary markets, and in terms of trading volumes in the secondary market. The equity market still remains the largest segment, even as the government securities market or the state development loan markets and the corporate bond markets have grown steadily. If we look at this chart, we can see the growth in the outstanding stocks of the Indian capital market. As you can see in the diagram or in the chart, that the blue line, which shows the government security market, have also been persistently growing from 2009 to 2018-19, while we have the corporate bonds and also the state development loans, all of them growing. But here the yellow line shows that of equity market capitalization. Okay, and as you can see, the right hand side, here we have, in the right hand side, we have in US billion dollars, we have the segmentation done, where we find that in the equity markets started from 1,366 US billion dollars. It has gone up to 2,202 US billion dollars in 2018-19. So we can say that there has been a streamlined, transparent and market-based primary issuance process that has underpinned the development of the government securities market, both in the G-SECs and the SDLs. In the primary G-SEC markets, the issuance are made as per a half-yearly pre-announced calendar. The calendar specifies the amount, tenor and issuance dates. The tenor of the G-SECs goes up to 40 years. And we also find that the weighted average coupon on the G-SECs has remained stable across interest rate cycles, imparting stability to the debt profile. The average maturity of issuance is one of the longest globally, helping limit the rollover risk for the central government. In this diagram, we find the secondary market liquidity in terms of average daily volume, where you have the blue lines showing the government securities, the orange line showing that of corporate bonds, while again the yellow line shows the equity volumes. So we find that the liquidity in the secondary market for the government securities has noticeably improved over the past decade. The average daily volume in the G-SEC and the SDL market have remained higher than the corporate bond and the equity cash markets, and the liquidity in the G-SECs is mainly concentrated only in some few benchmark securities, particularly the 10-year benchmark, and the SDLs are relatively less liquid than the government securities. We can conclude by saying that the most important function of capital markets is really to improve the transactional efficiencies. And this they can do by bringing those who hold capital and those who seek capital together, and also to provide a place where they can exchange the securities. So if we talk about the capital market structure, it is broadly divided into the primary market and the secondary market, and also in terms of size, all the major segments of the capital market have experienced consistent growth during the past few decades, and also mainly the government securities market, the corporate bond market, they have also grown steadily, while equity market still remains the largest segment in the Indian capital market.